All right, if you've been watching silver even casually over the last few weeks, you felt this one in your gut. Silver didn't just pull back, it snapped. Roughly 15% gone in what felt like a blink, right after pushing toward that $120 zone. And if you're here because you saw that chart and thought, what on earth just happened? Stay with me, because the real trigger isn't what most headlines are saying. This move matters right now, not next week, because it just exposed how fragile some of the most crowded trades in the entire market have become. And I'm going to walk you through exactly how to recognize this pattern yourself the next time it shows up, before the air pocket opens under your feet. Now, before I explain what caused this specific drop, let me teach you something most people don't really internalize about fast markets. Speed changes behavior. When price rises slowly, investors think. They analyze. They weigh options. When price rises fast, traders chase. And when price rises parabolically, leverage quietly piles in behind the scenes. Think of it like a crowded elevator racing upward. Everything feels fine until it stops suddenly, and then everyone realizes just how many people were leaning on each other to stay upright. That's what momentum does. It feels stable right up until it isn't. And silver, after one of the fastest runs in modern market history, was absolutely packed with momentum players. I'm talking about funds that layer on leverage when trends accelerate. I'm talking about retail traders who pile in on breakouts. I'm talking about algorithmic systems that buy strength and sell weakness without any emotion whatsoever. They were all there, and they all had the same problem when conditions shifted. No exit plan that accounted for speed on the way down. Here's what you need to understand about parabolic moves. They're not sustainable by design. They're emotional. When silver went from the mid-80s to nearly $120 in a matter of weeks, that wasn't careful accumulation. That was fear of missing out, weaponized at institutional scale. And that kind of move doesn't end with a polite rotation. It ends with a flush. If this is making sense so far, drop a comment below and let me know where you're watching from, because understanding this pattern is going to save you money in every asset class you'll ever touch. So, now here's what's actually happening under the hood. The headline story says, silver sold off. But the real catalyst came from the other side of the trade. The US dollar ripped higher, fast. After renewed uncertainty around Federal Reserve, leadership hit the tape. That matters because precious metals don't just trade on supply and demand fundamentals. They trade against currency confidence. When the dollar suddenly strengthens, it tightens financial conditions instantly. Now add leverage to that equation. When the dollar spikes, margin requirements change, risk models flip, and forced selling kicks in. That's the cascade. First, the currency moves. Second, algorithms react. Third, leveraged positions get unwound, and suddenly what looked like normal volatility turns into a vertical drop. Here's the sequence in real time. Dollar strength hits. Silver futures feel pressure. Stops get triggered. Margin calls go out. Funds reduce exposure, market makers widen spreads, liquidity thins out, and price doesn't walk lower, it gaps lower. Each step amplifies the next. It's mechanical, it's predictable if you know where to look, and it happens faster than most people can process. Now let me layer in the second part of this, because it's not just about the dollar, it's about positioning. When a trade gets this crowded, there's no graceful exit. Everyone runs for the same door at once. You've probably heard the phrase crowded trade before, but let me make it concrete for you. In the weeks leading up to this drop, speculative positioning in silver futures hit levels we hadn't seen since 2011. Open interest was elevated, call option volume was surging, and sentiment surveys were showing extreme optimism. That's the fuel. When everyone's already in, there's no one left to buy, and when selling starts, it feeds on itself. But here's the part that should make you nervous if you're not paying attention. These moves often feel random after the fact, but mechanically, they're anything but random. They're predictable reactions to stress in the system. You can't predict the exact day or the exact trigger, but you can absolutely identify when conditions are ripe for a washout. High leverage, extended price action, extreme sentiment, and a catalyst that shifts the foundation. That's the checklist. And silver checked every single box. Now zoom out with me for a second, because this is where pattern recognition matters. This is the exact same playbook we saw in 2011 after silver's blow-off top. Silver ran from under $20 to nearly $50 in a matter of months. Then it collapsed, dropped 30% in days. Everyone said the bull market was over. And you know what happened? It wasn't over. It took years to build a base, but the fundamental drivers didn't disappear overnight. Look at 2020. Silver surged from the teens into the high 20s on monetary stimulus and supply concerns. Then it corrected hard when the dollar bounced in late 2020. People thought it was done. It wasn't. It resumed higher as the underlying thesis reasserted itself. Every time this has happened, the first drop felt like the end. And every time, it turned out to be an inflection, not a funeral. There's a pattern here. Sharp corrections after extreme runs tend to reset positioning, not destroy the underlying thesis. They shake out the weak hands, they clear the leverage, and they create conditions where the next leg can actually build on a more stable foundation. I'm not saying that's guaranteed to happen this time. I'm saying it's what history shows us when the fundamental backdrop remains intact. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this drop mean silver topped forever? Sure. Markets don't owe anyone a rally. And yes, manipulation narratives always surface during moves like this. You'll hear people say it's the bullion bank suppressing price. You'll hear conspiracy theories about coordinated takedowns. Maybe there's truth in some of that, maybe there isn't. But here's the thing. It doesn't actually matter whether there's intent behind the mechanics. The mechanics are what you can observe and what you can act on. Focusing on what you can control, that's what matters. Currency strength, that's real. Positioning data, that's real. Speed of the prior move, that's real. Those are inputs you can track. And right now, none of them say the long-term silver story is broken. They say it's stressed. They say it overextended. But stress and extension are temporary conditions, not permanent states. There are probably 3 types of people watching this right now. The first type already owns silver, and you feel punched in the chest. Maybe you bought near the top. Maybe you've been holding for years and just watched gains evaporate. If that's you, your job isn't to panic. It's to reassess your time horizon. Were you trading momentum or investing in a cycle? Because those are different games with different rules. If you were trading, this might be a stop out and a lesson learned. If you were investing based on long-term supply deficits, monetary policy, and industrial demand, then this is noise. Painful noise, but noise nonetheless. Your thesis doesn't change because price got volatile. It changes when the fundamentals change. The second type, you miss the run, and you're secretly relieved. You watch silver rip higher, and you didn't chase it. Now you're wondering if this is your entry. If that's you, don't rush in yet. Let the dust settle. Volatility after leverage unwinds can last longer than you expect. You might get a better entry, you might not. But waiting for stabilization is smarter than catching a falling knife just because it looks cheap compared to where it was last week. And the third type, you're skeptical of the whole thing. You think it's hype, maybe even a trap. You don't own silver, you don't plan to, and you're just here to understand what happened. That's healthy. For you, the lesson is still incredibly valuable. Watch how fast gains attract leverage. Watch how fast leverage disappears when conditions shift. That lesson applies to every asset you'll ever trade. Bitcoin, tech stocks, commodities, doesn't matter. The mechanics are universal. So here's what I want you to answer in the comments. Which type are you? Are you holding and reassessing, waiting for entry, or watching from the sidelines? Because your answer shapes how you should be thinking about what comes next. Now, let me tell you where I stand. I'm not panicking, and I'm not blindly buying dips either. I'm watching. First, I'm watching the dollar. If dollar strength fades, if we see the DXY roll over from these levels, pressure on silver eases immediately. That's the primary variable. Second, I'm watching how silver behaves after this shock. Does it stabilize and hold support, or does it keep cascading lower? If it holds above the low hundreds, that's constructive. If it breaks below and keeps grinding, that tells you the washout isn't finished yet. Third, I'm watching positioning data. When the COT report comes out, I want to see if speculative longs have been flushed, because washed out trades often set the stage for the next move higher. This drop was mechanical, not emotional. It was driven by currency strength and leverage unwind, not by a fundamental change in the silver market itself. The supply deficit story hasn't vanished overnight. Industrial demand for solar, EVs, and electronics hasn't disappeared. Central banks haven't suddenly become hawks after years of printing. Those fundamentals take months and years to shift, not days. And if history rhymes, if we see anything like the patterns from 2011 or 2020, this correction may end up being the thing that determines whether the next leg higher gets delayed or launches harder than anyone expects. I'm not a financial advisor. This is not financial advice. Do your own research, make your own decisions. But if you made it this far, you're someone who thinks independently and wants to understand the machinery behind the headlines. That mentality will serve you well. Share this with someone who needs to see it. Subscribe if you want more breakdowns like this when markets move. And stay ahead of the noise by learning to recognize these patterns before they play out. Think critically. Verify what you're seeing. And make decisions based on evidence, not emotion. Stay sharp out there.